Stop what you're doing. I'm serious. Pause the video you are watching. Put the phone down, listen carefully. Because what you're about to hear is not a chart prediction, not a macro theory, and not another silver is undervalued argument. This is a claim, a leak, allegedly from someone inside the bullion banking system. And if this information is even partially true, we are no longer talking about price targets. We're talking about days. Who is making this claim? The source of this information is a commentator known online as Asian Guy. He claims he received a direct leak from a senior bullion bank trader, someone involved in the physical silver market, not a retail analyst, not a YouTuber, but a participant. According to this claim, the paper silver market is no longer stressed. It is scheduled to fail. The central prediction. Here is the core allegation. Within 47 days from January 13th, 2026, the paper silver market collapses. Physical silver disconnects from paper pricing, and the physical price is alleged to surge toward $400 per ounce. Not gradually, not over years, violently. Why this is different from every other silver story. You've heard silver hype before. Everyone has. What makes this claim different is not the price target. It's the mechanism. This is not supply and demand might tighten. This is not the Fed might pivot. This is an alleged engineered event with a trigger date. The alleged Silver Accords. According to the leak, on December 17th, 2025, a secret agreement was signed, referred to as the Silver Accords, allegedly involving the Federal Reserve, the U.S. Treasury, multiple foreign central banks. The stated goal? To remove physical silver from circulation and create artificial scarcity, not to stabilize markets, but to control fallout. Why silver? According to the claim, silver is the weakest link in the global paper metal system. Unlike gold, silver is consumed industrially. Silver inventories are smaller. Silver is more heavily fractionally lent. In simple terms, there are far more promises of silver than actual silver. The fractional reserve allegation, this is where the story gets explosive. The leak claims bullion banks are operating on a 57-to-1 ratio. That means for every one real ounce of silver, there are 57 paper claims, futures, ETFs, unallocated accounts, swaps, all pointing to the same metal. A system that only works as long as nobody asks for delivery. Why delivery matters now. According to the claim, that assumption has broken. Physical silver is being demanded, and not by retail investors, by industrials and sovereign buyers. Once delivery requests exceed a certain threshold, the entire structure collapses, and that brings us to the trigger. The January 16th trigger. According to the leak, there's an automatic system rule. If the Shanghai silver premium stays above $10 per ounce for 14 consecutive days, all silver lending halts, no extensions, no waivers. The system shuts. That condition is allegedly met on Friday, January 16th, 2026, 3 days from the time this claim was made. What happens after the trigger? According to the allegation, once lending halts, bullion banks cannot roll positions, delivery failures cascade, and the fractional system collapses within 72 hours. Not months, days. Why ETFs are central to this story. ETFs like SLV claim to hold silver on behalf of investors, but according to the leak, they don't, or at least not enough to honor delivery claims. The allegation is that these ETFs will invoke emergency clauses and cash settle investors at the paper price, while physical silver trades elsewhere at dramatically higher levels. What that means. In practice, imagine this scenario. You own silver at 80 fast on paper. Physical silver trades at $250, $300, $400, but you receive cash at $85. That is not a hedge. That is forced liquidation. The industrial panic claims silver is not optional. It is used in solar panels, electronics, medical devices, military systems. According to the claim, annual industrial demand is 680 million ounces, but real accessible supply could drop to 200 million ounces. When that happens, price no longer controls demand. Production does. That is what economists call perfectly inelastic demand. Factories pay whatever it costs. The Federal Reserve problem. The leak alleges the Federal Reserve is deeply exposed through metal swaps and derivatives. Estimated losses, $240 billion. Losses that cannot be absorbed quietly, which would require printing. And once that happens, confidence breaks. Why the dollar is part of this story. Silver isn't the end game. Confidence is. If the market sees that paper claims are meaningless, then all paper promises are questioned. Bonds, currencies, derivatives. Silver becomes the spark, the tone of the message. This is not presented as analysis. It is presented as a warning, a directive, According to the author, there is no second chance. You either act before the trigger, or you watch from the outside. What the author urges. The instruction is blunt. Do not buy ETFs. Do not buy futures. Do not trust unallocated accounts. Only physical silver, in your possession, before the window closes. End of part 1. In part 2, I'll examine the evidence cited to support this leak, the countdown narrative, iron, and the psychological pressure being applied. Because whether this story is true, partially true, or entirely false, the fear it is tapping into is real, and fear always moves markets. Now let's slow this down, because when a message sounds this urgent, this specific, and this apocalyptic, the most important thing to do is understand how it's constructed, not to dismiss it, not to blindly believe it, but to analyze it. The evidence being presented. According to the author, this alleged collapse isn't speculation. He claims there are signals. The first signal? Silver lease rates. Lease rates are the cost to borrow physical silver. When silver is abundant, lease rates are low. According to the claim, lease rates are spiking aggressively, which would suggest that physical silver is becoming hard to source. That's the first pillar. The Shanghai inventory claim. The second signal cited is plunging inventories on the Shanghai exchange. According to the narrative, silver inventories in Shanghai are being drained faster than replenished, which allegedly supports the idea that physical silver is migrating east and not returning. This matters because Shanghai prices are often cited as reflecting physical reality rather than paper leverage. The options. Activity claimed the third signal. Unusual options buying, specifically deep out of the money calls with short time frames. The author claims these positions are not retail. They're allegedly institutional and allegedly timed around the same 47-day window. To the storyteller, this isn't coincidence, it's foreknowledge. The Fed balance sheet argument. Next comes the Federal Reserve. The claim here is that recent balance sheet activity shows irregular precious metals swaps. Swaps that, according to the leak, expose the Fed to enormous losses if silver reprices. Again, this is not independently verified, but it is presented as part of a pattern. The countdown psychology. Now, this is critical. Notice how often time appears in this message. 47 days, 3 days, 72 hours. January 16th. Specific dates create urgency. Urgency overrides caution. The human brain is wired to respond to countdowns. That's not finance, that's psychology. Why the message is structured this way. This is important. The narrative follows a classic structure, insider source, hidden agreement, suppressed truth, imminent trigger, one correct action. This structure is powerful because it makes the listener feel late, threatened, but still able to escape all at once. The insider fists everyone else. Frame. The author positions himself not as a marketer, but as a messenger, someone reluctantly sharing dangerous information. This framing increases credibility because it implies personal risk. If this wasn't real, the listener subconsciously thinks, why would he say it? The binary choice. At the center of the message is a forced binary decision, paper or metal, dollar or silver, act or lose everything. Binary framing eliminates nuance, and nuance is where skepticism lives. What happens if nothing happens? This is the question every listener should ask. If January 16th passes and nothing collapses, the narrative has built-in exits. It can claim the trigger was delayed, intervention bought time. The leak was early, not wrong. This is how apocalyptic predictions survive, not by being right, but by being flexible. Why these stories still matter. Here's the key point. Even if this specific story is exaggerated, it taps into real vulnerabilities. The silver market is highly leveraged. Physical inventories are smaller than paper claims. ETFs do contain legal escape clauses. Those are facts. Fear thrives where truth already exists. The real risk to viewers, the greatest risk here is not silver going to zero. It's panic-based decision-making. Buying anything, silver, gold, crypto, stocks, out of fear rather than strategy creates regret. What a grounded take looks like. A grounded response recognizes. Precious metals can be insurance. Physical and paper are different instruments. No single asset is a guaranteed lifeboat. And most importantly, no one has perfect information. Not YouTubers, not banks, not central planners. Why these narratives are increasing. Stories like this are multiplying because trust is declining. In currencies, in institutions, in systems. When trust erodes, people look for certainty, and certainty sells. The final message of this video. This video is not telling you to buy silver. It is not telling you to ignore silver. It is telling you to think clearly when urgency is weaponized. If silver explodes tomorrow, panic buyers won't win. Prepared investors might. If nothing happens, panic buyers lose first. The real question isn't, will silver hit $400? It's this. Are your financial decisions being driven by fear or by understanding? Closing. The story you just heard may be true. It may be partially true. It may be exaggerated. But the emotion behind it is real. And in markets, emotion moves faster than metal. Stay sharp, stay skeptical, and never let a countdown think for you.